The International Monetary Fund has raised the global growth forecast for 2023. It's pegging global growth of 2.9% this year compared to its October estimate of 2.7%. It also sees global inflation slowing from an estimated 8.8% in 2022 to 6.6% this year. And this supports market expectations that central banks are likely to be less aggressive in raising interest rates as inflation has peaked. Interestingly, for South Africa, the international lender has pegged economic growth of 1.2% this year, markedly higher than the Reserve Bank's forecast of 0.3%. Nompumelelo Siziba has more.
International market players have already begun to factor in a strong possibility of central banks taking it easier when it comes to the imposition of interest rates. This as inflation seemingly cools off. This will go a long way in boosting economic activity and in improving the value of the currency in consumers' pockets. But there are also other factors auguring well for a better global performance.
Above all, probably the decision by the Chinese authorities to lift all lockdown restrictions on COVID-19. And although this is creating the uncertainty about how China is dealing with the fallout from that in terms of the massive increase in infections, the markets and analysts are adopting a more positive view that says that opening up China implies an increase in potential demand from China for the world's resources, and that should help economic growth.
The IMF has hardly moved on its previous estimates for South Africa this year, pegging growth of 1.2% with a slight uptick in 2024. This is in stark contrast to the Reserve Bank's view that the local economy will grow by 0.3% this year and 0.7% in 2024. Speaking at the announcement of the interest rate decision last week, Governor Lesetja Kganyago cited persistent load shedding, with the bank estimating that South Africa would endure around 250 days of the same.
I don't believe that the IMF has fully taken into account what the Reserve Bank did in respect of the impact of intensified load shedding and the likelihood. I think the more important thing is here that there seems to be little light at the end of the short-term tunnel in terms of load shedding. I think the Reserve Bank has resigned itself to the fact that load shedding is going to be with us right through this year and next year.
While the global growth outlook has improved somewhat, certain risks remain. The Russia-Ukraine war could intensify, which would have adverse effects, including the potential for increased geopolitical fragmentation. The IMF also warns that China's recovery remains under threat, given that the country is still contending with higher incidences of COVID-19 infections. There are also concerns that a number of emerging and developing economies are now struggling with higher debt burdens on account of the higher global interest rate environment, threatening to put such economies on the back foot. The IMF says this needs to be addressed urgently. It says other policies that must be spearheaded include continuing to bring down inflation, containing the emergence of COVID-19, ensuring financial stability and supporting the vulnerable, which the international lender says will go a long way in setting the global economy up for better improved growth. Nompumelelo Siziba, SABC News, Johannesburg.
All right, for more on the story, I'm joined in studio by my colleague Nompumelelo Siziba, who's been covering it. Nompu, thanks so much for your time this afternoon. Why does the IMF seem less pessimistic about global growth this year than it did last year?
So last year in October, the IMF was pegging economic growth, global economic growth for this year of 2.7%, and it's upwardly revised that to 2.9%. Now, part of the reason for that is, number one, they say it's a positive thing that China has decided to open up the economy because for the longest time it was fighting COVID infections. That is a double-edged sword because on the one hand, they've opened up the economy, but their infections have been going through the roof. So they're, trying to manage that. But they see that as a positive and they see it as a negative. That's one positive. And the other issue, of course, is that last year was that year when central banks went mad with raising interest rates. And of course, the purpose of that was to fight inflation. And the IMF seems to think that that sting has actually worked. The economies around the world are beginning to feel the effects of it. But monetary policy, when an interest rate move is made, it takes anything between 12 to 18 months or even longer for it to take effect in the economy. So the cumulative effect has yet to be fully effected. So they do think that there's still a risk that there's going to be a continued raising of interest rates, but albeit at a slower pace. And I think we've begun to see this. If we saw our very own Reserve Bank just raising interest rates by 25 basis points last week, whereas before they raised interest rates by 3 consecutive loads of 75 basis points. And there is evidence, that inflation is beginning to come down. So that's the reason.
They seem to know something about the South African economy that even our Reserve Bank doesn't, forecasting 1.2% growth for South Africa, while the Reserve Bank has said we're going to grow at just 0.3%.
Well, I would beg to argue that it's the other way around, that our Reserve Bank actually has a lot more knowledge, a lot more granular knowledge about what's happening in the local economy than the IMF, all due respect to it. Remember, they're looking at a broad range of economies, the whole global economy. They can't possibly have that granular information. The data that they work with is, a whole lot of data that comes their way without not necessarily being on the ground to get a sense of what's happening. The minutiae, like you say. And also as well, remember, they have to concoct all of this data at a certain time. So the time that they make their conclusions about economic growth in various countries and when they publish it, there's a time lapse. And if you think about what's been happening in the South African economy, we have gone through the most in just 1 month.
Nompu, although it's positive that the economic growth worldwide was revised upwards, there are still many risks that the IMF see. Take me through some of those.
Yes, of course, there are always lots and lots of risks. So one of the big risks, the elephant in the room, of course, is the Russia-Ukraine war. That really set things off last year when Russia invaded Ukraine on the 24th of February. Suddenly, supply chains were, started crumbling as a result of it. But of course, that was a follow-on as well from what happened with COVID. Food inflation went through the roof. Fuel prices went through the roof, and so on and so forth, and that spurred inflation further, even though inflation had begun to pick up anyway, because you remember, as we all came from the COVID-19 lockdowns, there was a lot of pent-up demand. People wanted to go out and buy, and on top of that as well, the United States economy, for one reason or another, was flying. Well, I say one reason or another, there is a reason behind that. They gave the economy such massive fiscal support, even giving people $600 a month to stay at home to ensure that they could continue to look after themselves. And so that, that helped that economy. The fiscal support helped that economy. So as a result, they kept things going and they grew quite nicely. It's estimated that they grew by 2% last year. So some of the other risks, apart from the Russia-Ukraine war, are inflation. Even though they see it coming down, there's a risk that it may flare up again depending on what happens with the Russia-Ukraine war. If that intensifies, all those risks that we saw taking place will come back. They're very much on the horizon in terms of higher global food prices, fuel prices, and so on and so forth. They do see a risk in terms of, with the higher interest rate situation, emerging and developing economies, some of them that don't have the best fiscal metrics. They haven't been able to manage, and they've had to spend money that they don't have, going deeper into debt. And when you go deeper into debt, and of course, if the interest rate is high, you have to now service that, service the burden of the debt. And that costs more because you're paying a higher interest rate. Now, if you're spending more on your interest rate bill than you are on the basics, that begins to fundamentally put you at risk in terms of your ability to afford food and the basics in an economy. I mean, we're not there yet as South Africa, but we know that we're spending a heck of a lot of money on our loan service debt each year, and it's taking away from us being able to spend on the key priorities in the economy.
Nompumelelo Siziba, the anchor of On Point, as well, joining me there for an explanation. Nompu, if you want to stay also and present the rest of the show with me and continue explaining, that would be fantastic.
You're doing a fantastic job.
Thanks so much for that, Nompu.